Hi, it's Larry Gaines, PowerCycleTrading.com. In this video, I want to show you a really neat strategy, and this is what we call a calendar spread, or sometimes referred to as a timing spread. So what I'm looking at here is Coca-Cola. So you can see Coke has had a pullback like everything else, and it's coming back down into this good support zone right here. So this is a 382 retracement at about 57, 50 simple moving average right here. So the thing to do on this trade, I'm looking at let it pull back, see if it pulls back a little bit more into this 57, and then we could set up a calendar targeting 57.5 or $58 for like a 2 to 3 week spread. So let me show you what that would look like. Now the reason to do this, if you look at the option chain here, this is Coca-Cola and here's your option series. So here's the 28 February series, 2 days to expiration into Friday, and you can see it's got a 27.51% implied volatility. We go to the next weekly series, so the 6 March series, 24.91 implied volatility, and then we go out to the next series, the 13 March, at 23.87. So we've got an implied volatility is higher in the front months. Okay, so with the virus scare, the volatility has gone up in the front months versus the back months, and that's usually the other way around. So what we can do here is take advantage of that by selling the front month volatility, and also we get the advantage of time decay. So theta, you can see this front month, if you did the February 28, you've got a theta decay of 8 cents, and you go back here to the March 13, we've got 3 cents. So we get that benefit, that delta of the theta. So we could do a couple things. We could target $58. So we could do, based here, we could target a $58 strike here. So we could buy the 58 right here, and then we could sell the 58 right here this current week, 2 days to expiration. And look how cheap. We could get into that for 50 cents. Okay, a debit cost, that's your max risk. So we could do that, or we could do the 58 here for the March, the 13 March, and we could then sell just the next week out, the 6 March, and we could get into that for $14 of risk. Okay, so this is a really neat strategy, and then what we can do is we can play this as an income strategy. For example, here, if we did this where we're long the 13 March 58 call, we're short this week the 28 call, the 58, we can get into that for about 50 cents, and if it goes out at 58 on Friday, this could be up over around $38 on a risk of 50. Or we could do it for the next week, so we could just be long the 58 13 March series and sell the 6 March series, and we could get into this trade for about $14 of risk. Now next week, if this goes to $58, I'll put this on next week's date right here. If we go to $58 next week, this will be up potentially up to $48 on a risk of 14. So it's a really great way to play a very low risk timing trade, taking advantage of implied volatility kind of being spiked in that front month, and then also theta decay. And the other thing we can do, if we don't get the move to 58, we can just let the 58 let this 6 series expire worthless at 58.66 cents. Take that in, and that's going to reduce down our long dated call from $80 if we're long that by the 66 we received there. So we'd be in this trade, we'd be long the 58 call at, what is that, $14? 88 minus 66, yeah, $14, and then we can do a lot of different things there. So it just gives you a lot of flexibility, and these are very low risk trades, and in this kind of trade environment, that's what I like to look for, low risk, directional, kind of defined risk trades. Hope this helps. If you'd like to learn more about these types of strategies, join me this Saturday. I'll be doing a free live workshop on calendars, diagonals, covered calls, married puts, and things like that. Hope this helps. Talk to you on my next video update.